making some efforts to maybe revitalize the story. Can this be a big wealth creator from here? It's very initial days. We'll have to see what they plan to do and how they will do it, etc. But at least we've seen some action. Go on.
But then I'm not tracking ABFRL that closely, but what I can tell you in the business of retailing, it's unit economics which matters the most. And what matters is basically store level unit economics. And that should be more than your cost of capital. So ROC at the store level should be more than the cost of capital, and typically at 18-19%, if you're able to achieve that, I mean, you're going to have a winner. So I'm not so sure as to what this demerger would mean in the case of ABFRL, but I mean, I would look at that metrics to understand whether they can achieve that. But beyond that, I really don't track ABFRL that closely, Prashant.
Okay, got it. Manish, thanks for that. Well, the market, the headline index may look flat, but don't be fooled by that, because beneath the surface, there's so much action happening. Prashant was mentioning AB Fashion, which is up 10%. Look at other stocks, right? Adani Power is up about 5% right now. IRDA has come back in a big way. IRDA's, is still up almost about 50% this year already. So it's sort of gained a lot of traction. Then you have NBCC, Chola Finance, etc. So lots happening in the broader markets. Manish, hi, good morning. I wanted your thoughts on the two-wheeler space because you track this space closely. We are seeing signs of a big revival in the export market. So we're seeing it with Bajaj Auto, with TVS Motor. But the problem here is these stocks have rallied a lot. Do you see any incremental value?
So PVs and two-wheelers are likely to do better than CVs and tractors even in FY25, but the growth rates in FY25 over FY24 for two-wheelers and passenger vehicles is going to be slower. Now, the valuations have already run up. There is competition or let's say some sort of cannibalization that is going to happen from, let's say, electric two-wheelers, etc. Subsidies are also going away, slightly muted in FAME 3, then FAME 2. And in that backdrop, I would believe that the auto performance in FY25 compared to FY24, and particularly with reference to two-wheelers and passenger vehicles, is going to be slightly muted. Because the valuation, will catch up with the earnings growth, which is going to be slower than what we have seen in FY24. So largely the auto play in FY25 has played out. There is going to be some rundown impact of the, the elevated valuations that we have seen in FY24. And I think, what is more comforting is the ancillaries, because auto is a 12 lakh crore market. And obviously, if export starts to pick up and India becomes the hub of auto ancillary exports, I mean, that is one space which looks very exciting, whether it be, light manufacturers, LED manufacturers, it could be your battery management systems and a whole lot of tire companies, so on and so forth. So I think the OEs don't look that exciting, but ancillaries look much more promising.
Okay, all right. Hi, Manish. Good morning. Good to see you, Ben. How are you placed between the staples versus discretionary? Discretionary stocks, they delivered great numbers and they got re-rated multifold. While the staples, well, the numbers weren't that great, but valuations seem pretty okay in comparison to what they've traded in the past. How are you all placed between them? Will you stick with the discretionary stocks, or do you think in an election year, you'd rather turn your attention to staples?
Neither for a larger picture, a broader picture, I think 2010 to 2020 was all about consumer stocks with or without earnings. there was re-rating. 2020 to 2030 is all going to be about investment related. Of the three pillars of the economy, consumption, savings, and investments, 2010 to 2020 was consumption and savings. 2020 to 30 is going to be savings and investments. So obviously, staples in recent times, you would have seen that bulk of the raw material price increase has been absorbed. Companies have actually taken price increases to the extent they could, but volume growth is missing. And valuations are not really that palatable even now. Yes, they have corrected, they have gone through time correction. Obviously, when you had elevated valuations and earnings growth don't come, then valuations do tend to correct. So I think it is an underweight staples even now, and rural demand, you don't know how things are going to be given that monsoons are likely to be okay this year, but there is a La Nina, there's an El Nino and all of that. I think I'm more positive on urban discretionary consumption because that seems to be firing on all cylinders. And obviously it is all about per capita income. And we've seen that the earning growth trajectory for consumer discretionary has been much better than staples. And even though volume growth is not there for staples, the margin performance, because they have taken price increases and earnings CAGR over the last 2-3 years has not been that disappointing. Whereas it is going all guns for consumer discretionary space. And I think post-elections, consumer discretionary, when there's increased capex and there's more money circulation in the economy, there's a accelerator, on the multiplier effect. All of that is going to mean that consumer discretionary is likely to outperform consumer staples in the next 1 year at least.
Okay. I wanted to ask you a slightly medium-term view on the market as well, Manish. Do you think we are staring at a pre-election rally? Because, there are a lot of events, right? Political events recently indicate that there is further strength that we're seeing with the NDA. And the one thing that the market likes is policy and economic continuity. I mean, that's a recipe for further market strength. So heading into election season, do you think this could be a one-way rally? And if yes, what is the best way to approach it?
But the valuations are very reasonable. If you assume 1150 sort of a EPS number on Nifty benchmark index for FY25, then at 22,500, you're broadly trading at 19.5, 20 times. That is not expensive at all. But most of the market participants have factored in a continuation of the present regime of the government. Now, can they be a future re-rating in the run-up to the elections? I mean, given the lot of uncertainties and a whole lot of things that is happening between now and the elections, you don't know. There is a case of a negative surprise if something happens that NDA doesn't come back to power. I mean, there can be a lot of negative surprise. But the positive re-rating of the market, still the elections is somewhat over. You can't get a positive surprise now, between now and election results from 4th of June. I think the next big surprise is only going to happen. Massive re-rating will happen on 5th of June or 4th of June onwards. Till that point in time, it's a wait and watch. And it's all about positioning your portfolio from the medium-term perspective, not the immediately next three months perspective. I think there's going to be a lot of volatility this whole liquidity analysis, there's a lot of churn that is going to happen in the broader markets because of the liquidity factor coming into play. All of these things are going to keep the markets in check between now and elections results. But I think fundamentals are perfectly fine. We are building in something like 17, 18% sort of an earnings growth for FY25. That's very good. And 20p on FY25 numbers is one peg. It's not expensive at all. But I think future re-rating will take time after the results.
Before the results, actually before the elections also, that's 19th when things kick off, Manish, we'll get the manifestos, right? And that should be, we'll get the manifestos from the BJP and the NDA next, probably, I think, in the next few days should have, right? Because 19th the polls start. Do you think that will give us some sense? I mean, if it's well detailed, what are going to be the big areas of focus? I mean, at least for the next couple of months, that's essentially what the market perhaps will latch on to, I think.
I think if the manifestos talk about major reforms coming in the third term of the NDA government, which is basically judicial reforms, UCC is well known that it is likely on the table. All of these things may actually trigger a big move, because the country actually needs serious judicial reforms given the pending cases in the courts, etc. But otherwise, I think everything else is known in media, through media, etc. What the present regime of the government is thinking about bringing changes in the country. But if they don't come back into power, then obviously a lot of negative surprises will hit you. And obviously, the manifesto of the opposition will come into picture. But that's how I would look at it. I would really think that there is no major surprise in terms of manifesto, nothing really much.
Okay, all right. Final question, Manish, before we let you go. What about cement? The last quarter hasn't been great because of pricing. They're struggling to push through pricing, but volumes are very, very good. I think the street is waiting by let the election get out of the way. The price increases will come about, and obviously the consumption of cement is going up itself. So how would you approach this space? Some of the stocks have seen a fair bit of correction, case in point being a Dalmia Bharat as well. That's down to around 2,000 rupees.
Imagine, when the capex cycle is in an upswing, the entire value chain will gain. And that would include raw materials. And obviously, cement is going to be one of the key raw materials that goes into capex. And volume growth is happening, but pricing is an issue because, capacity utilization in certain parts of the country are not that great. And there's a slowdown mode between now and election results. So I think pricing action will improve post-election result because capex will pick up, ordering, etc., will pick up post results, and I would believe that cement on correction looks like a great buy from the next 2-3 year point of view. As I said, that capex cycle, every aspect of the value chain will gain between now and let's say 6-7 years from now. So it's a buy on dips, I would believe.
Okay, a buy on dips in the cement space. Got it. Thanks a lot for